Okay, welcome back to our closing session for the conference. And it's my pleasure to introduce our closing keynote speaker, Randal Quarles. Randy is currently the chairman and co-founder of the Cynosure Group, a private investment firm, and a current role gives him a direct vantage point on many of the themes that we've been discussing today. How capital is allocated, how risks are priced, how private markets evolve, and how technological changes affect investment strategy. Randy also brings extraordinary public sector experience. He served as a member of the Federal Reserve Board from 2017 until 2021 and was the first vice chair for supervision, a role created after the financial crisis to oversee the safety and soundness of the banking system. In that position, he was at the center of debates over how to calibrate regulation, debates that remain highly relevant as finance continues to evolve. While at the Fed, he also succeeded Mark Carney as the chair of the Financial Stability Board, the international body that monitors vulnerabilities in the global financial system and coordinates among national authorities. That perspective is especially valuable today because many of the issues that we've discussed, private credit, digital assets, stablecoins, AI, and cross-border payments, don't fit neatly within traditional regulatory categories or national borders. Earlier in his career, Randy was a partner at the Carlyle Group, where he helped lead financial services investment activities and held senior roles at the U.S. Treasury. I first met Randy 25 years ago when I was a young economist in the international division of the Treasury, and Randy was the Assistant Secretary for International Affairs. And something that made Randy distinctive to me and my colleagues at that time was how kind, open, and engaged he was, even with junior members of the Treasury staff, taking us and our perspectives seriously in the discussions and debates that we were having about policy at that time. So it's my pleasure to be sharing the stage with Randy this quarter century later. And just one more thing before we start. I'm wondering how many people in the room are familiar with the documentary The Last Dance? Okay, so for those of you who aren't familiar, this was about the last season, Michael Jordan's last season as a Chicago Bull, and their quest for a sixth NBA title, kind of the culmination of both the season and that film was this iconic shot that Michael Jordan made with 5 seconds left to Game 6 of the 1998 NBA Finals to beat the Utah Jazz. So imagine my surprise when, during these vigorous online debates, as the Fed and the Treasury were rolling out extraordinary policy responses to COVID, I see this tweet. So it says, always a Federal Reserve angle. Game 6 of the 1998 Finals is on, and the current Fed Vice Chair for Supervision is sitting courtside. Someone ask Randal Quarles about this. So let's zoom in here. Okay. So it's a little bit fuzzy, not definitive, so I have to start by asking, Randal Quarles, were you at The Last Dance?
I was, and Jordan pushed off.
Pull up the replay. Randy, thank you so much for joining us. And you've seen the financial system as a regulator at the FSB, at the Federal Reserve, at the Treasury. You've also gotten to see the discussion that we've had here today. What insights did you draw from today's discussions? And what seems genuinely new versus sort of just a kind of traditional financial stability challenges in new guise?
Well, it's been a great conference that has covered a lot. I think what seems new versus what are more traditional risks, I wouldn't say just traditional risks, because I think I think it can be instructive to see how much some of what we're looking at today is really similar to what we've seen more than once in the past. So I brought the agenda up here just to sort of review. With respect to private credit, what I took from the discussion, what seemed to really be a theme of the discussion, was that the financial stability risks of private credit are financial stability risks that we have seen before and that the regulatory system is designed to respond to. It's designed to respond to the risk of credit judgments having been misguided, of over-concentration of credit in certain areas. I thought, as I thought about the risks of private credit, the risk of technology is not particularly relevant to private credit. The fact that a lot of private credit has been directed to technology firms, whether software firms or now AI firms, is, so technology has a factor there, but the overconcentration of credit and credit booms and credit cycles, I mean, that's something we've seen for a long time. I by myself do think that what we're seeing with the direction of capital, both credit and equity, into AI and data centers, the build out, I think that's a story that we have seen since the railroads. We've seen since the inception of sort of modern finance. When I was a young lawyer half a century ago, we met a quarter century ago. When I was a young lawyer half a century ago, I worked for one of the great New York law firms that had made its reputation representing J.P. Morgan in the restructuring of the railroads in the 19th century. And so when I would finish my day's work at around 10:30 in the evening, I would call up from the warehouse the files from the 19th century, which are not available to scholars because it's still subject to attorney-client privilege. J.P. Morgan is still a client, it still exists, so it couldn't be shared. And I would study, so how did everything happen? You really didn't want to invite me to a party in those days, but because I was no fun. But you saw a very similar situation. You saw a technology that was absolutely revolutionary. It was going to change the world. It was not just going to change how certain jobs were done. It was going to change how the economy was organized. But if implementing that technology required an enormous amount of capital investment at the outset. And that capital investment was being invested competitively by many different companies that were all seeking to dominate this technology. And the result was, it took much longer than people were expecting for that technology to actually have the effect that it was always going to have. But that took several decades. But in the meantime, all of these companies went bankrupt. Indeed, they went bankrupt repeatedly, even as they were in the process of changing the world because of the nature of the financial requirements of implementing that technology. So, I sort of cast my mind back to those late nights with the warehouse files from Davis Polk and say, this looks like a very similar story that we're seeing here. But from the point of view of financial stability, financial regulation, financial risk, it's not a new story, and it's not something that requires any change in how regulators have traditionally thought about financial stability or financial risk. You've got companies that are extending credit. They're making these credit decisions, and the issues are capital, liquidity. How do you address that? Making sure that you understand making sure that you understand the data, that you've got information from the system. So I don't think there's really anything new there. I think it's quite interesting. Indeed, I think that's an old story. Digital assets and stablecoins, that was an exciting panel. I think the message, again, that I took, and that as I think about stablecoins, really since the beginning of the intense interest in stablecoins from a regulatory and financial stability point of view, I don't know that there's a lot that's new there. the financial stability issues with respect to stable coins, I think we heard that from the panel, are highly similar to those with money market mutual funds. The requirement that you've got a vehicle, you've got a structure that is runnable in certain situations, and can you create a system around it to protect against the implications of that run. We've seen that multiple times with respect to the money market mutual funds. We saw it in the great financial crisis. There were measures that were taken to try to address that runnability, and those turned out to actually make the issue worse when it came to the COVID event. The decision was, well, because these structures are runnable, we need to require them to put down gates to prevent people from running once the asset pool has shrunk a certain amount. It can only shrink a little bit, and then we'll drop gates. Well, of course, that only accelerated the run when that actually happened in the COVID event, because people said, we got to get out of here before they drop the gate. We can't wait to see whether the asset shrinkage is going to continue. So that took a lot of work. But the issues are not dramatically different. I actually agreed with Hillary's comment that I don't know that there's a crying need for stablecoins, but I'm a libertarian. Why not? This is not, I'm nobody's mother. If that, there's not a crying need to prefer cod to salmon, but some people do, and they should be able to eat it. Provided that we can make sure that there's not mercury in it and that it's not dangerous to eat. And I believe that's entirely doable in the same way that as we have addressed those issues for money market mutual funds. On the emerging role of AI in finance, again, that was a very interesting discussion. The main thing I took away from it is that there is a big risk. It's probably the first time in my career that I've seen a risk of the financial regulatory system getting Ubered. The Fed is not, it is not part of the Fed's self-image to imagine itself susceptible to being overrun like a taxi and limousine commission. And if it sets itself across the railroad tracks and shouts stop, the Fed expects people to stop. And for most of my life, they have. And I think the discussion about the nature of this technology being so multifariously applicable, so easy to use, it's very similar to what happened, with the Uber app. It's like you push a button and a car comes. Well, that's so useful that as all the taxi and limousine commissions of the world said, no, we got to take a lot of time to think about this, it just ran over them. And I think the biggest issue for the financial regulatory system with respect to AI is that while they're saying, how do we think about safety? How do we think about structure? How do we think about analysis? This is so useful. I mean, as everybody has talked about here, as Governor Cook began with, carefully saying that she doesn't use it for her Fed work. I probably would have, but I have 4 AIs open all the time, and I feed them different requests, and the answers come back. It's like, this is really useful. And if somebody told me, you actually can't use it until we have figured out, which may be in a couple of years, exactly how we want you to use it, be like, that's not going to work.
So let me press you on the libertarian perspective that you described, and also on this this idea, which you emphasized with AI, could move very fast. So we keep on encountering this problem in our financial system where there is rapid innovation. It creates a problem so big that then the government feels compelled to come in and stabilize the system, to do a bailout. which raises this issue of, kind of the privatized gains and socialized losses. And so that's what I would offer as the risk. If you wait to see where these technologies go, maybe you only see the problem when they scale in a way that they create a systemic problem that then implicates the rest of us. So how do you see those risks, and then how do you respond to them?
So there are issues, developments, products that you can say hold off while we see how they develop, and there are those that you can't. So for example, private credit would be something that, again, it's responding to a need. There are a whole bunch of reasons it has developed, but that is within the ken of the regulatory system to say, we're scaling it back, we're putting limitations on it, whatever. You could do that. In the aftermath of the great financial crisis, there was a significant shift in the way that the financial regulators approached financial risk. So leading up to it, and I remember the first time I saw it, there was a group of a small group of the great and good that included Democratic appointees and Republican past appointees who were listening to Dan Tarullo, sort of in the early period of the great financial crisis, talk about what the response was going to be. And he emphasized that it was going to be focused on directly limiting activities. Mm-hmm. Whereas there had been kind of a bipartisan agreement over a long period of time that you can't figure out what activity is going to be what activity is going to be the problem, and that you needed to ensure that you had a fundamentally resilient system, and that was principally regulation of capital and liquidity, and possibly, there was a difference of view among the Poindexters about the regulation of culture. But capital and liquidity, that's what you need to do, because you couldn't tell what activity was going to be the problem. And I remember I was sitting next to some, quite prominent ex-Democrat folks as well. And there was just like an intake of breath around the table as Tarullo said, no, we're going to be focused now on limiting activities as opposed to just capital and liquidity. I continue to think that the capital approach was discredited because there wasn't enough capital when we got to the great financial crisis. I continue to think, however, it was the right approach. We just needed more capital. And that we have now done that significantly, and that's how you ought to be thinking about some of these technological risks. You're not going to be able to figure out, okay, AI, what particular risk is it? Is it going to be the private credit that's going to be a problem? Is it going to be a run on a stable coin that's going to create a problem in the financial system? Is private credit going to create a problem for all the insurance companies that hold the private credit, and the banks are exposed to the insurance companies? Is that what the risk is going to be? You just need to ensure that the system has appropriate financial cushions, and then you can be freer in allowing these technologies we've been talking about to develop, keeping an eye on it, but the risk of what they are likely to do is, you're handling that by creating a resilient system.
So let me ask, in the context of a recent high-profile failure of a financial institution, Silicon Valley Bank.
Yes.
This has become a focal point of debates about regulation and supervision. So I'd like your take on what lessons do you take away from its failure? In particular, how do you assess the Fed post-mortem view that a less assertive supervisory posture was a contributor to Silicon Valley Bank's failure? And then, what do you think lessons do we take away for these other new technologies? Are there any lessons to take away for, actually, let me add one thing on Silicon Valley Bank. That was another example where deposit insurance is only to $250,000, but the federal government came in and, effectively indicated people were going to be made whole because they were worried about a run on the bank. So illustrating this point about the government ends up being pulled in. So how do you view that episode in that context, and whether what you just mentioned about sufficient capital and liquidity thresholds is really enough in an era of fast-changing technologies?
So there's a lot there. So let me just start with your question about the Fed's postmortem. I would say that wasn't actually the Fed's postmortem. That was a governor, sponsored they sponsored a memo that hadn't really been shared with the rest of the board before it was circulated. They didn't have much time. I don't necessarily fault them for the deficiencies of that memo, given that they tried to produce it in a month so that they had something to respond to. Some of you in the room may be familiar with the fact that although I had been gone for a couple of years, the memo concluded that I had something to do with the failure of Silicon Valley Bank. And as I read it, so when I was at the Fed, I would occasionally get these emails from this woman who was in a mental institution just outside of Marseille. And they were addressed to 5 people: the Pope, Barack Obama, Bill Gates, Janet Yellen, and me. And they were very plaintive. They accused me and Bill Gates of collusion in a variety of quite serious crimes, which included colluding with her sister to keep her imprisoned in this mental institution. And they were mostly appeals to His Holiness to intervene and to try to break up this cabal.
I can't wait to see where this is going, Randy.
And even though they were accusing me of terrible crimes, and even though I knew that these emails had been written by someone who was confined for life to an institution for the hopelessly insane in the south of France, I was kind of flattered. And I felt much the same way reading this memo from the Fed. What it indicated was that was not the problem. The lax supervisory practices were not the problem with Silicon Valley Bank. I think that the best explanations of catastrophic events are those that don't depend on everyone involved being either a crook or a moron. So if you assume that the supervisors and the people running this bank were basically adept, how could this have happened? Because when you looked at its balance sheet, it's like, okay, well, there's a big interest rate risk here. There's a big problem. And I think, the answer I think quite clearly is that the business model of this bank was to accept very large deposits with, depositors with which it had a business relationship. And we had for a long period of time, as bank supervisors and regulators, had the view that these deposits were uninsured because they were very large, because they were business deposits, but that uninsured deposits that were business deposits were not nearly as subject to runs as retail deposits would be, because you've got a whole bunch of relationships with your bank if you're a business. They've made, they're handling your company's treasury activities. They've made loans to your company. They've made loans to your company executives. There are 401ks that they're managing. There's just a network of relationships, and you are not going to pull those deposits because of something you read at lunch on Twitter. Except that they did. And I think the right postmortem of Silicon Valley Bank is not the supervisors were lax, because they weren't particularly lax. They had a whole bunch of MRIAs and MRAs against Silicon Valley Bank. They had 31, 32, several times the typical number that a bank would have. They were on top of the situation. They just didn't have their hair on fire about it, because decades of experience had taught them, as it had taught the bank management, as it has taught everyone, that those deposits, we got time, because those deposits aren't going to run. And then they ran in an unprecedented way. The previous largest bank failure in America had been WAMU in 2008, and $1.8 billion a day had left that bank for 10 days in a row, total of $18 billion, and that was viewed as so catastrophic that the regulators had to come in and close that institution, which was a little bit larger than Silicon Valley Bank. Silicon Valley Bank lost $50 or $60 billion in an afternoon. There was another $100 billion that was ready to leave in the morning. In less than 24 hours, you had something that was multiples of anything that anyone had seen before in the history of the country. What I think the lesson of that is that the technological developments of the 21st century, communications developments with social media, bank technology developments with the ability to interact with your bank without actually going into and dealing with it, have created a much higher liquidity need in the system than we had realized was there. And we hadn't experienced that since the institution of deposit insurance in 1935. So the Federal Reserve was created because we had a bank system in the 19th century that had a huge liquidity need. And every bank had to self-insure its liquidity. And as a result, we had run after run and financial crisis after financial crisis, and the Federal Reserve was put in place to precisely to say, okay, we're going to address that by providing liquidity liberally to institutions that need it in the event of a run, and we're going to centralize the provision of this liquidity. Then, with the development of deposit insurance in 1935, the liquidity need of the system was much less, and so the Fed was hardly ever called on to exercise this function. The muscle was gradually lost, and indeed in the aftermath of the great financial crisis, because of the political criticism there was of the Fed of having exercised that function, they actually recreated the 19th century banking system. You had a regulatory requirement that every bank had to have much higher levels of liquid assets, and then as a supervisory matter, the Fed actually said to the banks, don't count on us to lend to you. As we as a supervisory matter evaluate your liquidity resilience, we are not going to take into account that we can lend to you. You must stand on your own bottom, which is exactly what every bank had to do in the 19th century, which was a disaster. I think that the right lesson of SVB is that the Fed has to reinvigorate its role as a provider of liquidity. Because unless you because the liquidity need is now so great with these developments in technology that meeting it through deposit insurance will require a deposit insurance level that is so high that that will create much more moral hazard than the Fed returning to its original role of saying, we will be the liquidity source when these runs happen. And that there is no way that a bank can self-insure the need to provide $140 billion of liquidity in a day without simply becoming a money market fund.
Mm-hmm. And outside of the liquidity, so taking a step back and thinking about the lessons applicable of SVB to the topics we've discussed today, are there any, what I hear you saying is make sure that there's high enough capital, large enough capital buffers in the system so that the risks that financial institutions are taking, they have the capacity to absorb. And then second, have, in this era of things moving really quickly, count on the fact that there's going to need to be higher liquidity provision from the Federal Reserve. Are there any other things in this? Is that, do I have your kind of view right?
Absolutely.
And are there any other things that regulators ought to be doing in this era of, especially, I think what Silicon Valley Bank showed and what your description alluded to is just there are things that come out of left field that we don't see.
Right.
And I'm wondering, is there anything else you think that regulators should be doing based on your seeing this from the inside? So,
an issue that the financial regulators have had for a long time, technology risk, particularly, what in my day, which, I only left the Federal Reserve about 4.5 years ago, and it already seems like a quaint time. We called cyber risk. But the regulators were not particularly good at evaluating cyber risk. Now, there are parts of the government that are fabulous at evaluating cyber risk. The security parts of the government, the NSA, the Homeland Security, they're great. And there's very little interaction, effective interaction between the financial regulators and those people. They're different sorts of people. I mean, they hardly meet each other. I think that the government could do a much better job of trying to bring those groups together so that the financial regulators could benefit from the real expertise that there is in places like the NSA and Homeland Security on these cyber issues, which would also be relevant to issues that are being raised by technologies such as AI.
I'm going to go to the audience momentarily for questions, so please prepare those. Just changing gears a bit, can you say a word about how does Cynosure use AI in its investment process, how does it shape its investment strategy?
So I would say the single thing that I could say about AI that is about how we think about and use AI. We do use it in investment analysis. We use it in sort of organizing investment approaches. But just as an example of, again, the spread of how this technology is going to affect things. So Cynosure does a lot of things, but with respect to the investment of private capital in equity, we principally provide growth equity to what I call unloved companies. So there's a ton of growth capital for tech. There's a ton of growth capital for healthcare. If you have invented, if you have a company that makes housings for electrical equipment and it's going gangbusters, there are 1,000 middle market LBO companies that will buy your company. There's almost nobody who will come in and provide you growth capital. So that's what we do. They're very unexciting companies. It turns out, for example, none of you may know, that buying porta potty companies is a gold mine. This is an incredible investment. And you would think that was as completely distant from AI as would be imaginable. And it turns out that one of the principal ways that that we increase the value of these porta potty companies is by using artificial intelligence to improve the routing of going and emptying the porta potties. That's very, it saves a lot of money. That's quite consequential. And it is an application of AI that I would not have imagined. So, so that helps underscore my belief that, again, this is a technology that is going to not just increase productivity and not just increase productivity in certain aspects of the economy, but like the railroads, is going to transform the economy. It will take more time than people are expecting. The singularity is not arriving by September. And I do believe that there is a significant risk of this investment, the financing respecting the investment boom, resulting in a big crash, just as happened with the railroads. But it is definitely transformative of a much broader range of things than some people might imagine.
Going to need a lot of porta potties for those construction sites for the data centers.
Absolutely. That is a big thing that they're doing right now.
Okay, let's go to the audience. Questions?
Thank you for your service. I'm Salil Petroda. As you think about the AI boom and CapEx investment cycle, I'd just be curious on your hypotheses on what catalysts might be for the eventual reckoning and crash you talk about.
So, lots of people have thought about this, and I've heard really clever ripostes to it as well. That I think come from people who very young people who are leading investment in this that I really admire. It's like I never knew anybody who was that clever when I was your age. I think you are going to lose $2 billion in the smartest way I have ever seen. But I think what we're going to see is, again, very similar to what happened to the railroads. You have, a capital investment requirement that has to happen across a broad network, has to happen rapidly, and people haven't quite figured out the monetization cycle. So, and lots of people have commented on this. Right now, when you created, an old data center, a pre-AI data center, you could live with the technology within that data center becoming outmoded, and typically the amortization period would be 6 to 8 years, and it's like, by the time you got to year 4 or 5, that technology was dated, but you could live with it. Anyone who's worked in a big bank, I mean, they're still using stone knives and bearskins in some parts of a big bank because it doesn't make financial sense to replace them yet. So, and you can live with it. Not great, you can do it. With AI, the difference, of course, is that it's not a question of when do those chips become outmoded. It's when do those chips stop working because they are running 24 hours a day, and they will, the current life cycle is anywhere from 18 months to 2 years. So you're making an investment, these enormous amounts of investment, and accountants and financiers, everyone's used to thinking, and we are going to amortize that investment and earn it back over the course of the next 6 to 8 years. How do we do that? Not 100% clear, but it seems as if things are moving in the right direction to do that. But nobody has any idea how you're going to amortize that investment over a year and a half. And then it's like, it's not that I can live with the technology within this data center being outmoded for a while. It's like, I got to replace the chips. They're dead. So that, I think, is the fundamental capital investment issue that the AI investment boom has to deal with. And again, as I say, I have heard very clever ripostes to this that I did not find compelling.
Other questions?
It's just a little bit out of the immediate field of view. I really haven't heard a lot today said, a little bit earlier in one of the panels, but it said about the financial regulator that is near and dear to my heart now, because I used to be in the banking world, right? OCC was in the Fed, but now it's SEC and FINRA. What are the implications of AI for those regulators and that part of the financial industry?
I think, and we saw some of it. I mean, using AI, in enforcement, in trading activities, I think there's a lot that can be seen there. I mean, again, for most of my life, I've been very surprised at the patterns that the SEC and the CFTC have been able to see in trading, I guess just from looking at spreadsheets. I mean, but now with AI, it ought to be much easier to see patterns and so forth. So, in that respect, I think it's a very obvious tool for those regulators. The implications for the structure of regulation as opposed to the execution of enforcement, I think are more traditional, which is you've got, again, if, as I suspect, you're going to have kind of a crash of the current boom, which I don't expect to result in any sort of, I expect that to be more like the dot-com bubble crash as opposed to anything like the great financial crisis. It's like, okay, well, that happens and that should happen. But ensuring that there's been appropriate disclosure around the decision-making that those companies are making and the investments that they're seeking, I think that's all sort of traditional nuts and bolts for the SEC.
Let's go over here.
Hi, Teresa Kong, Independent Trustee, Impacts Funds. If I could ask you to continue to extrapolate from studying the records of the railroads to the implications of what happens when you have such a huge contribution on the capital side of the production function as opposed to labor. And when we know that at least back then, we still needed people to pound the nails into the railroads, whereas today, those economics are accruing back to the providers of capital at such an increasing speed, similar to what you described with Silicon Valley Bank, right? Mm-hmm. As we are all part of an academic institution here, we're all trying to foster the next generation of thinkers, contribute to society. How should we think about this 3, 5, 10 years, whether we're an undergrad, a grad? What does the L part of that labor actually mean in that world? Or economies accrue back to the K, and productivity is supposed to grow at a stratospheric level. Thank you.
So, again, the history of revolutionary technologies is that increasing productivity has generally been a benefit to labor. And now we can include white-collar labor. We can include the folks in this room in that analysis. And I think that it would be here. So, again, I started out as a child in the Coolidge administration as a lawyer. And one of the things that lawyers had to do, I'm looking around, there may be some folks with enough gray hair who might have some familiarity with, you had to shepherdize cases. If you were a young lawyer, a big thing that you did was you would go down to the library and there were books that determined whether a case that somebody wanted to cite in a brief, had been overturned or not. How had, all the cases that it had subsequently been cited in. And you had to do that by hand. You had to look through. There was somebody who by hand collated all of this, and then you had to by hand go look through all of that. My son just graduated from law school, has no idea what I'm talking about. None whatever. And this was like a big part. Another thing you did as a young lawyer was that at night, you and the very young people from the investment bank would go to the printer. And then you would slug the documents. They would bring it out and you would have made some changes in the documents and you'd read the first word of every line. Because in theory, when it was done by linotype, if something had changed within the line, that would have changed the beginning of the word. And so you would read the first word of every line until the word was different, and then you would read it again until you came to a word that was the same. You would read the first. This was a practice that was universal. It was part of the professional development of everyone on Wall Street, and it disappeared because of the computer within a year. But there are more lawyers now than there were in the Coolidge administration. I mean, the lawyers are doing things that are more interesting and more remunerative, more valuable, more productive. The example from a few years ago that probably many of you have heard, I'm on the board of our health system out in our part of the country, in the Intermountain West. And and one of the things we heard was, okay, well, AI right now can read an X-ray or can read an MRI better than any radiologist, right? So radiology, that's going away. Like as of today, that can be done. That was 3 or 4 years ago that I think I heard that. as of today, there are quite a few more radiologists than there were 3 or 4 years ago, because the ability of AI to read those scans is actually increasing their productivity, making them more valuable in the system. So I strongly believe that the lessons of history and the lessons of this particular moment are that this technology, by increasing the productivity of labor, including white-collar labor, is actually going to increase its usefulness and is not going to replace people, but is going to increase what they can do.
Randy, thank you for this stimulating discussion. We could ask so many more questions. Let me ask everyone to join me in thanking Randy for closing out our conference.